Dear students, in continuation of the fifth module after the completion of capital structure, today's session we will be dealing with cost of capital. What is cost of capital? For any business, the investments should get a return. As far as a company is concerned, there should be a minimum return that a company should get from its investment without any change in the value of the firm. Value of the firm we had already studied. What is that V? We had studied the V as S plus B. Now in capital structure we had studied this in detail while applying NI approach, net income and net operating income approach of David Durant, and similarly and all we had studied V, value of the firm. So here that is the important point. Okay, minimum rate of return any company should get on its investment is known as cost of capital, but that return should be in such a way that market value of this firm should remain unchanged. No, it should not disturb the market value of the firm. So, KO is the term which is used for overall cost of capital. This KO we had studied in the chapter Capital Budgeting 2. While studying capital budgeting IRR method, we had studied this KO. So that is it. So what is KO or what is cost of capital? It is the minimum rate of return a company must get on its investment where the market value of shares remain unchanged. As far as a company is concerned, this KO constitutes a lot of things. That is, cost of capital constitutes cost of equity capital, cost of preference shares or preference capital, cost of retained earnings, and cost of debt. Why it constitutes all these things? Because as far as a company is concerned, the investment into the company will be in the form of equity shares, preference shares, and the company's yearly retained earnings or reserves will be there from which is accumulated from the profit or transferred from the profit. And similarly, the company may also raise, apart from this, debt capital, which may include debentures, bonds, and other borrowings or loans. So when a company makes investments by means of equity shares, preference shares, retained earnings in the long run, and through the external source of finance, debt equity or debt, not debt equity, or debt which includes debentures, bonds, borrowings, and long-term loans, it should get a minimum return. That is what this cost of capital implies. So minimum return of cost of capital, why we are dividing into equity, preference, retained, and on the debt basis is because KE indicates that minimum return a equity shareholders should get, minimum return preference shareholders should get, minimum return or minimum retained earnings should be there for a company, and minimum rate of interest should be paid for the debt or debentures or bonds. All these constitutes cost of capital or overall cost of capital. So in this chapter we will be dealing with KO, which is also known as weighted average cost of capital. This is another term for overall cost of capital, weighted average cost of capital. Before getting into the equations and problems, there are certain things which we have to know while studying the cost of capital. Cost of capital have high relationship with business risk and financial risk. High relationship with business risk and financial risk. Business risk I am putting it as B, and financial risk I am putting it as F. What is business risk? If a company is unable to cover its fixed operating costs, it is called as business risk. No, if a company is unable to cover its fixed operating cost, it is called as business risk. How it happens? Because there will be sometimes change in sales. We will not get expected sales. Shortage of sales will be there. In such cases, the EBIT, earnings before interest and tax of the company, will come down. If it comes down, what will happen? The company will not be in a position to meet its fixed operating expenses like interest and other fixed costs. So that is called as business risk. If a company is unable to cover its fixed operating expenses, it have business risk. It may affect the return to the shareholders. That is what I told. Cost of capital have high relationship with business risk. If business risk is high, then what happens? The cost of capital may come down. Equity shareholders may leave the organization because enough return is not there for the organization. Similarly, there is something called financial risk. What is financial risk? If the company is unable to meet its financial obligations like interest, dividend, etc., it is called as financial risk. So the KO is having higher relationship with business risk and financial risk, which we want to look into the cost of capital. So cost of capital constitutes three important things: business risk, financial risk, and riskless cost of a particular type of financing. Riskless cost here indicates any business will have a minimum return. Whatever may be, we will get a base minimum return. That is called as riskless cost of particular financing. Another important thing which we have to study under the cost of capital theory is explicit cost and implicit cost. It have the relationship with KO. What is this explicit cost? Explicit cost is actually the IRR. What is that IRR that firm pays to procure financing? Internal rate of return the firm pays to procure financing is explicit cost, or the definition is that explicit cost of any source of capital is the discount rate that equates present value of cash inflow with present value of cash outflow. So that explicit cost is there for a particular type of financing. It's the rate that firm pays to procure financing. Very simple language. It is the rate that firm pays for procuring finance or to procure financing. Whereas implicit cost is nothing else but opportunity cost. We have studied the opportunity cost in many management subjects. What is it like economics? Opportunity cost is the rate associated with the best investment opportunity foregone. So cost of retained earnings is an example of opportunity cost. Why cost of retained earnings or retained earnings is becoming an opportunity cost? See, from the profit, some reserves are transferred to the business. Balance only goes to the equity shareholders as dividend. If the reserves are less, what will happen? The equity shareholders will get more. If the reserves are more, the equity shareholders will get less return, but it is useful for the business because the company have high reserves. That is the example of opportunity cost. So there are implicit cost and explicit cost which is related with KO, and business risk and financial risk which is related with KO. Now we have to study the problems related with cost of equity capital, cost of preference shares, cost of retained earnings, and cost of debt, and weighted average cost of capital or overall cost of capital. There are various methods for calculating cost of equity capital. As I told, equity shareholders should get a minimum return. Without any change in the value of equity shares, it is known as cost of equity capital. There are various methods, of which first one is dividend approach, or it is also called as dividend capitalization model, or it is also known as dividend discount model. The equation here is cost of capital is denoted by KE. The equation is D1 divided by PO plus G. Excuse me. D1 divided by PO plus G. What is dividend? Here, before looking into the equation, you should understand that cost of equity capital is having a close relationship with the growth of dividend of the company. That is why it is the G is taken into account. G is the growth in the expected dividend. D1 is the expected dividend per share and G is the growth on dividend. And P subscript O is the net proceeds from share or market price of share. For example, in the given problem, taking an example, dividend per share is expected to be 1. So D1 should be taken as 1. And for dividend per share is expected to be 1 per share for the next year. So it is a expected dividend for the next year. So it is 1, we are taken as 1. And expected growth rate is 6%. So D1 divided by P0 plus G, here G we are taken as 6%. 6% means 0.06. 6 divided by 100, 6% per year perpetually. And where the cost of equity, what is the cost of equity if the market price of share is 25? So P0 is nothing else but no current market price of share. You should understand very clearly that market price of share is determined by the term P0, P subscript 0. So current market price of share. So KE we had found it like this, 1 divided by current, 1 is dividend per share, not the whole dividend or the percentage of dividend. Dividend per share in the next year is dividend. So dividend per share divided by market price of current market price of share plus dividend growth, we will get the cost of equity capital. See, there is one more thing. The price of the share for the next year, P0 is current market price of share. With this equation, we could also find out the price of the changes in the price of the share because of the dividend growth for next year. That we will apply the formula P1, P subscript 1. P subscript 1, the formula is dividend, expected dividend per share divided by K minus G. So that we are applying here. So the price of the share we are finding out. Next year dividend, how do we calculate? Current year dividend plus growth. Next year dividend we will get 1.06. So that P1 is dividend, existing dividend 1.06 divided by K. K we got 10%. So 0.10 minus growth. So this is all about dividend approach or dividend growth model. It's also called as dividend capitalization model or dividend growth model. Why? Because here the K is calculated based on the growth of the dividend. 3 components are there. Based on the growth of the dividend, first component, based on the existing dividend per share or expected dividend, not existing, expected dividend per share expected to be in the next year, and present or prevailing market price of share. So this is the first model under cost of equity capital. In the next video, we will study CAPM model, capital asset pricing model. Thank you.